3, 2, 1.
All right.
Welcome, everybody.
Cheers. Happy Mother's Day.
Take a drink. It's just water, folks.
Could be a mimosa if you're
It's
watching
too
this on
early.
Sunday morning, right?
Too early.
Mother's Day mimosas?
Yeah, man. I got to get ready for Mother's Day.
Yeah, it's a big weekend. Big weekend. Another big week in the market. Actually, as we're doing this on Friday morning, the Michigan Consumer Confidence Report came out, and the market had gapped up. Futures gapped up this morning, but once that Michigan Consumer Confidence Report came out, the stock market reversed. But I don't think it's going to be a problem. The week is definitely going to finish up, and we're going to talk about gaps basically because we had a pretty big gap earlier this week. Last week, the market's going higher. I mean, I hate to do the crystal ball thing, but it looks to me like the market's going higher, and it's painful because there's a lot of reasons why it should be rolling over, and now, like for example, that Michigan Consumer Confidence Report. I mean, the economy is weakening, and so it's not like, at the bottom, even in the bottom of 2022. Once things started turning around, the economy was getting stronger, and everybody was talking about Fed rate cuts, right? And so that was a big part of it, and AI was a big part of it. But that was driving the market higher. Right now, the economy is starting to roll over. So while yes, the market's going higher, and we only care about price, right? Which way price is going.
Yeah.
But in the back of your mind, you got to still look at what's going on in the world because things are slowing down.
Yeah. It's the slowing down,
Yeah.
right? That creeps up on you. And if you're not looking at the macro stuff, it'll creep up on you fast. And, the good thing is if you follow us, you're going to be in tune with that kind of stuff because we're watching it for you. And, there's, a lot of people are still waiting for this big correction, and it's probably going to happen. It's just nobody knows when.
Right. It's going to happen. The problem with, like, most people, analysts have a theory, right? And they position themselves based on what their theory is. There aren't a lot of analysts that do what we do, which is respond to the market, because the idea is that if you're responding, you're too late. You've missed the move. Well, yes, you have missed the move, because if you're trading the trend has to change before you can identify that the trend has changed.
Yeah.
Right? You have to see it. But if you position in anticipation of the trend changing,
You could be
and
completely
you're wrong,
off. Yeah.
It's
bigger than a normal loss.
Yeah, I mean,
when you're wrong, you're really wrong.
Yeah, and it can go both ways. If you think the market's going to roll over, well, especially if you're short, if you are not in TSP, but if you're betting that the market's going to go down and it keeps going up, you can go to zero.
Yeah,
like that's bad.
Yeah,
it's bad enough for us if you're in the G fund and the market's going up. That's opportunity cost. It's not great. It's not a good feeling, but
you're not losing.
It can be much worse,
Yeah.
right? Yeah. So, anyway, let's get into it. So, 12 May 2024. So we're going to talk about gaps. I think we did this a little while ago, but before I forget, the newsletter this weekend, because we were just talking about Fed rate cuts and stuff, right? The email last weekend that came out with, when we put the links to the show and the newsletter and all that, I was talking about what happens when the Fed cuts rates. On the newsletter this weekend, it's much more in depth about what the market actually does when the Fed cuts rates. And if you're a subscriber, you definitely want to read this weekend's email, because it goes along with that idea that, as the economy can weaken and price can keep going up, but at some point it all rolls over, and you just want to be watching for when that happens and respond to it. But you definitely want to look at that in the newsletter this weekend. All right, so we're going to look at gaps, breakaway gaps, continuation or runaway gap, same thing, different terminology, and then an exhaustion gap. We'll do a couple of examples of those and why it matters. The dollar and yield, this is kind of on the bearish side, but we'll take a look at that. Gold, everybody's talking about gold. It's gold is at new highs. We talked about it a couple of months ago. We put up a long-term chart. It's definitely broken out of a great pattern. The question is, if you're a retiree, let's say you have gold in your portfolio, do you want to be in gold? There's a lot of reasons to be in gold, but But I would say anything that you are in should be relative to the S&P 500, because you could just ride the index, right? You only want to be in gold if gold is outperforming the S&P, right? So we'll take a look at a couple of different ways to look at that, and does it make sense to be in gold right now? And then C-Fund chart. Okay, so gaps. You can look at this. This is a daily chart of the S&P 500, our C-Fund, right? There's a gap is just a space between where price closes and the next price opens. Okay, so if you do different time frames, if you looked at, you wouldn't see this gap on a weekly chart, for example. You can see it on a daily chart. So this is a bottom. This gap is a breakaway gap, right? It's coming off a bottom. It's very bullish. It's a breakaway gap, and it keeps going, and you go higher. This is a breakaway gap to the downside. Okay, the breakaway gaps. There's an idea that all gaps get filled, right? You might hear analysts talk about that. All gaps get filled. That's not really true. In the long scheme of things, it might be, but the idea about gaps, basically, you're looking for them in this channel. Okay, so this breakaway gap is probably not going to get filled, and it doesn't, because it's the beginning. It's the beginning of a new powerful uptrend. It's the same thing on the downside. This breakaway gap to the downside probably is not going to get filled. But if you have something like this, that's a runaway gap. It's in the middle, and it got filled over here. Okay, so it's important to know what kind of gap you're looking at. This one here, obviously, right? Gap here, and then a gap there, super strong, and then another gap here. And this is all part of this big, huge move we had off the bottom last November. So the odds of the market rolling over to fill these gaps are pretty slim. As you get further along into the rally, this is a pretty good one too, because this gap got us above resistance at that level. So this was a pretty powerful breakout right there. This gap, if you were a subscriber, was pretty significant for us because we reallocated out of the stock funds in large part due to that gap down. But where we are today, this is a big gap. Okay, we put a bottom in I think, can't remember what that was, April 19th, I think it was. And we didn't have a really powerful move out of here, right? We got a high, a higher low, a higher high, a big move down on that day. So it was a lot of churning. But once we got this big gap to the upside and it cleared this resistance, it's really bullish. And we're really close to new highs. So the odds of not going up here and making new highs are pretty slim. I mean, that should be the bias. You should expect the market to keep going and making new highs at this point. Just based on, even if we're just looking at gaps. And this was about a 5% drawdown, which in any year, 5%, you're going to get 1 or 2 5% drawdowns in any year. So I'm not too worried about this right now. This is really bullish. It's a 1-2, and we're off to a 3-4-5. I mean, I just think the market's going higher from here. But gaps are a good way to tell kind of where you are in relation to the tops and the bottoms. Here's another kind of good example of gaps. So this is Apple, daily chart of Apple. We talked about Apple before. It's the second largest cap-weighted stock in the S&P 500, so it's pretty important. So if we look at this line, right, it's 170, I think. Yeah, 170. So this is really a channel in there because it's not exact, but it can't get above it, right? It's resistance basically here. Once price gets above it, comes back down and keeps testing it. So now it's support, right? And it's that 170 level, give or take. Runs up again, double top, can't get above it, comes down, a whole bunch of support there, and then this monster gap up, right? So on the one hand, this is not this. We had a big move up, right? This is not a great consolidation pattern. It's a sideways consolidation. It would be much better if we had a pullback and then a move higher, but we didn't get that. But it certainly looks like, based on this gap up and support here at the last couple of times it came back to hit 170. Apple wants to go higher from here. So that's just kind of how you're looking at the chart and how you would apply gaps to it. But this is a really bullish one for Apple. So we'll see how that goes. Okay. So the dollar yield and the S&P. This is a little bit wonky, so help me out here. Don't fall asleep on the other side over there, bro. And ask me a couple questions if you want, because this is a little bit wonky. So, but it's important.
I'm sitting on the edge of my seat. I don't know what you're talking about.
So the dollar index, okay, the dollar is in candlesticks, and the S&P 500 is in orange, okay? It's a daily chart. So from a high level, when the dollar, we're going back to the beginning of 2022, when the value of the dollar is going up, the C fund, right, the S&P is going down. Okay, it's not a day for day, but clearly it's inversely correlated, right? When the dollar comes down, the S&P is going up. Okay, there are a couple times in here when the dollar and the S&P are going up at the same time, right? So that's kind of a red flag that something's going on. Okay, and in this case, the dollar reversed and broke down, and so the stock funds continued higher, right? Which is what we expect, because ordinarily when the dollar's going down, the S&P is going up. So the dollar resolved down, which enabled the S&P to keep going higher. But once the dollar put in a bottom, right, that was the top for the S&P. And so when the dollar starts rising, the S&P starts falling. Okay, so early this year, we were in another area where the dollar was rising and the S&P is rising, right? So it has to resolve that one way or another. And as the dollar kept rising, eventually the S&P rolled over. So it resolved, the dollar kept moving higher and the S&P moved to the downside. So what we're looking for right now, if the dollar the dollar looks like it started to move down, right? And the S&P moved up, which makes sense. So if the dollar can break this trend line to the downside and keep moving down, the S&P keeps moving up. Okay? So we're looking for the dollar to break through that trend line to the downside. Right? It's the same kind of thing for yield. So this is the 10-year Treasury yield. Okay? When yield is going up, the S&P is going down. Right? When yield is going down, the S&P is going up. It's inversely correlated like the dollar. And again, we got a couple times in here where yield is going up and the S&P is going up. But the yield, it's kind of hard to see because it all overlaps, but the yield chart really breaks out right there. And that's when the S&P rolls over. So it resolved to yield kept moving higher and the S&P rolled over. Right? So we had the same thing last summer going into that correction last summer. You got yield moving higher and the S&P moving higher, but yield resolved to the upside. It kept going higher and the S&P rolled over, right? But once yield peaked, that was the bottom in the S&P, right? So once we got up there at 5%, that was the bottom for stocks. And they started moving higher. So and then yield comes down, right? And stocks go up. So this year, yield is trending up, okay? And the stocks were moving higher, right, in the first quarter. But eventually, yield continues higher and stocks rolled over. So yield in the last, kind of hard to see here, but in the last couple of weeks has turned down and stocks are going up. So again, like the dollar, we want to see yield fall. And it's very likely that we will, because as the economy continues to weaken, yield will fall, should fall, and the market goes up until some other things happen, and then it comes down. But for the short term, if yield keeps coming down, the S&P keeps going up. So yield and the dollar, two critically important things to watch. Make sense?
Yeah, actually.
Right.
I mean, I think it's good that people understand these correlations, right? These things that either correlate, don't correlate, inverse, like because it took me a while to kind of grasp this stuff, and you go, oh, well, it's easy to. It all starts to become clear when you understand if something is going up, something else is going down.
Yeah.
Right now, in our most recent past, sometimes that doesn't always work together like it has, but generally speaking, it does. Right. So I'm referring kind of like bonds to stocks, right? Where they historically travel in separate directions and not so much in the recent years, but generally speaking, it's good to understand these kind of things that move together or apart, so that you can, again, you're not guessing,
right?
But you're using that to say, okay, well, if generally speaking, when this goes down, this other thing's going to go up, so I should expect it to go up.
Right. It definitely helps you anticipate. I mean, if the stock funds are going up, and the dollar starts going up, and they both start going up together, you have to watch it, because it's going to resolve.
Something's going to go the other way.
Yeah.
Yeah, that's the key part right there. So that's a good way to put it. When they're both going the same direction, you really have to dial it in, because one of those isn't going to keep going that direction.
Right.
And so these are all things that you layer on together to give yourself more confidence in your decisions, right? That's kind of how I look at it, and what you do is you find which ones of these speak to you. Right? So if it makes sense to you. If it doesn't make sense to you, it's not useful. So again, when Jerry goes through these, take this as it's like I could see some people going, oh, why are we even talking about this? Well, this is educational, right? Because you need to understand these relationships between these assets. And this isn't just for the TSP. This is just across the market in general. Right. If you understand these relationships, then you can make better decisions with your money.
Yeah.
Because if you see this thing going on and you're like, oh, wait a minute, if that's happening, then this is going to happen.
Yeah. I mean, you don't know exactly what or when, but some of these relationships can tell you that something is going to happen. And that is really all you need to know, right?
That's the most important thing, right? Knowing that something's going to happen. You're not going to be able to figure exactly.
Right.
But you know something's about that. It's like when a light turns yellow.
Yeah, pretty much. Yep.
Right? It's called caution for a reason. Like, hey, pay attention.
Yeah. It doesn't mean you have to sell all your stuff. It just means
pay attention.
Pay attention. Yeah. Okay. So gold. GLD is the ETF for gold. We talked about this a few months ago, but this is a really, really good cup and handle pattern for gold, right? We talked about when it kept coming up here, hitting resistance, and when it got above that resistance, this one, it got above it, came back and retested that line and broke out really big a few weeks ago. This is a weekly chart of gold. Going back to when the GLD, the gold index, gold ETF started. So you might look at that and say, awesome, gold broke out, and a lot of people think gold is going higher from here. I tend to agree. We might get some kind of a pullback before it keeps moving, but I would agree that the expectation is that gold moves higher from here. The question is, why would you own gold? And for me, it makes sense to own it relative to the S&P 500, because gold is only one asset, so it's going to be more volatile than an index of 500 companies. And if you can buy the index, and since that's the benchmark generally anyway, I want to be in gold if gold is going to outperform the S&P, right?
Right.
And I want it to be going up.
Now, the problem is so we're talking about an ETF called GLD.
Yeah.
The problem is people confuse that with actually physical gold.
Right.
So you hear a lot of things, and I don't want to sidetrack us too much, but I did want to make sure when we talk about gold, for whatever reason, I guess it's just because the algorithms in social media know that we're involved with the TSP. We've seen a lot lately about people talking about how you can use your TSP to buy gold. Now, again, we talked about this a few shows ago, a while back. There are reasons wealthy people buy physical gold. There's good reasons behind it, right? We won't get into all that because this isn't really applicable to the TSP. But I only say that because then what happens is all these other shysters basically use that kind of thought process, that narrative that gold is good, you should buy gold. And they kind of, I don't want to say sucker you into, because some of these are legitimate ways to invest in physical gold without investing into it. So there are some legitimate companies out there. What they're doing is taking advantage of this idea that buying physical gold is a great hedge in this, kind of downturn of economy, whatever you want to call it. But it's all about the details.
Yes.
So please, if you get roped into one of these kind of, deals, you've got to get the details. What are you actually buying? Can you sell it? What is it worth? And most importantly, if you put most of your retirement into this kind of idea, you're on a bad. If it sounds too good to be true, it is.
Yeah, we're going to kind of show it
Period.
actually, but the thing that comes up in my feed all the time is this company that says that you can invest in TSP in gold, and you can't. I mean, there's not even a gold fund in the mutual fund window. Like
There's in GLD.
no,
There's some
no.
equivalent.
There's a metals. There's
Some precious metals
yeah.
mutual funds, right? That's the other thing I was going to mention is the difference between the two, right? You'll see some that are precious metals, and what they're doing is kind of packaging all those together to kind of take advantage of that.
Yeah, I mean that's the idea, right? And there's some derivative products in there too. So it's not like you're buying a fund that buys physical gold. That's not, and it's not in there. So I'm pretty sure I haven't followed this company too far down because what it wants is your email and all that, and it's not getting it. But basically, what they want you to do is roll your TSP into their company that buys gold. And so, no, you cannot have gold in the TSP.
Yeah, you can use your TSP money, but it's all about the details.
Yeah.
And, get yourself a financial advisor before you go too far.
Okay, so this is what the actual chart of the GLD looks like, right? And it's breaking out, and that's great. This is the ratio of the GLD to the S&P 500, okay? So again, we're going back to 2005 when the GLD ETF began. And everybody remembers 2005 is kind of in between 2000 and 2007 was the other top. So we're right in the middle there. Gold, GLD, way outperformed the S&P 500 from 2005 to 2011. Okay. You also remember during that time, the S&P 500 really collapsed, right? So the question is, it's great to be in gold because it's outperforming the S&P, but gold could still be going down, just not going down as fast. Okay, so we'll get to that in a second. But the relative chart is really important because generally, I want to be in gold when gold is outperforming the S&P. I don't want to be in gold when the S&P is outperforming gold, right? Because S&P is in the denominator. So when the line is going down, it means whichever is in the denominator is outperforming. So from 2012 to the bottom of the ratio was 2022, the S&P 500 was outperforming gold. Now it's bottoming, right? We're getting we have a lower low or a higher low here than we had here. So it's starting to do this bottoming pattern. And if we can get a breakout to the upside, that will probably be bad for C fund holders, but that would mean that gold again is starting to outperform the S&P 500. So when the ratio turns and starts moving markedly higher, that's when you want to be in gold versus the S&P. Okay, so that's how you would trade it, right? If I'm looking at, I want to be in the S&P when the S&P is outperforming, or I want to be in gold when gold is outperforming. The other way to look at it is if you're a buy and hold investor, let's say. And let's say you bought the GLD back here in 2005. So this chart is a percent chart. So the zero line is where we were on that day there in 2005. So on a percentage basis, how much has gold gone up and down? So this is gold, and this is the S&P 500, right? So from 2005, like we said, gold was really outperforming the S&P into 2011, right? And you can see it obviously was. I mean, gold was up 300% at the peak here, and the S&P was only up, 20% relative to where it started there in 2005. So gold obviously was way outperforming the S&P. But then gold starts coming down, the S&P is continuing to go up. So obviously now gold is underperforming the S&P, right? But again, if you're looking at it from a long-term perspective, if I bought gold back here, gold has outperformed on a percentage basis over that entire time. So if you're trading gold, right, if you want to be in gold when it's outperforming the S&P, you need to be looking at a relative chart like this. If you're buy and hold gold for whatever reason, you're in great shape. right? Gold outperformed. It came down, but it had outperformed so much that when it came down, it still, on a percentage basis, did better than the S&P during that whole rally. So you have to understand when people talk about gold and why you would own it, are you trading it relative to the S&P? Are you holding it for the long term? Just understand the arguments. That's all I'm saying. That's why the distinction between these charts. Okay. All right, C Fund. So we talk about this every week, but this is the weekly chart of the C Fund. So each candle is 1 week of price action. The blue line is a 20-week moving average line. Once we got above it after COVID, right? Every time, this is the COVID bottom right here. Every time price pulled back, it found support at that 20-week moving average line, right? Until this week in January 2022, which began this bear market that we had in 2022. And then we started putting in some higher lows. That's the key. Higher lows and higher highs. Now the trend has changed, okay? Even this one broke through, but still you have a higher low, right? Then once we got kind of clear of this churn, every time price came down, found support at that 20-week until here, it broke through, right? This was a rough time because a lot of people thought the market was going much lower from there, particularly because of that failure of that 20-week moving average line. But once we got back above it, we stayed above it. Okay, so the recency bias is tough because we bottomed out last October, beginning of November, and we were well above that 20-week moving average line, into this year, the first quarter of this year. So 1, 2, 3 weeks. We talked about this last week. We had 3 weeks of support at that 20-week moving average line. And last week was really bullish, right? It opened at the bottom of that rectangle, got all the way down to the 20-week moving average line during the week, and then came all the way back up and closed at the top of the rectangle. So it was really bullish. So if we flip forward to this week, right, we had 1, 2, 3 weeks of support at the 20-week moving average line and a huge move to the upside this week. So if you're following on a weekly basis, it definitely pays to expect that we're going to get support and wait for the move down through that 20-week, right? Because anybody could have said anywhere along here, the market's getting ready to roll over, ready to roll over. Well, okay, just keep watching it until it actually does roll over. Yes, you're going to take this drawdown from the all-time high, but you've gotten this whole move to move up, right? And you're protecting yourself from this move down. That's the whole idea behind what we're trying to do. You are not going to time, quote unquote, time the top of the market. You need to see this trend reverse, and you saw it right there. You need to see the trend reverse before you can respond to it. So you are not going to, I hate the term time the market, but it's all over Facebook and everywhere else. This idea of timing the market is a thing.
Yeah, well, it's just
not what we're doing.
Easier, to regurgitate what you hear other people say.
Yeah.
So when you hear people on, Bloomberg or whatever say, you can't time the market, and it's an easy punchline.
Yeah.
It's an easy punchline. But what do they really mean by that? Well, what Jerry's explaining here is it's very difficult to anticipate the market changes, right? Meaning you get ahead of it before it happens. That is timing the market, right? I see it's going to change, so I'm going to get out before it does. Okay, well, that's crystal ball stuff.
Yep.
But if you see the trend change and you confirm it with all these tools that we're talking about, you're not really timing, you're responding to the market.
Yep.
If you don't respond to the market, what would you do otherwise, right? So that's the part where they lose me. Yeah. I'm like, okay, I get it. Timing the market is not, very possible. You can get lucky and do it right a few times or whatever, but generally speaking, you can't guess what's going to happen.
Yeah.
But let's say you confirm that there is a downward trend. It is clear that it's happening. You're just going to watch it. You're just going to stay in because you don't want to time the market. You start to lose me after that part. And that's where we get especially in our Facebook group, we have 31,000 people in there. And there's just a large portion of them that are just so they won't let go of this stuff that they've been told, right? I don't even like to think that they've learned it. What they're doing is repeating it.
Yeah.
Because they don't really know any better. And so that's why we don't really engage in it, to be honest with you. We're not here to convince anyone.
Right, no.
We're just here to put the content out, and if you feel like this like speaks to you, awesome. Because I wasn't always this way. I wasn't always this type of investor. I made very poor decisions young in my life because I listened to the way my grandparents did it or whatever, you know, and it's just a very different way of looking at things, right? You can look at, if you're buying individual stocks, then you better know about the companies. You better be in the fundamentals, right? But at the end of the day, all it really matters is the price going up or is the price going down. And then when you back up into like an index with 500 companies, you can't know everything about all 500 of those companies. So it's really kind of pointless. Unless you want to spend a lot of time, I guess you could.
Yeah.
You know, we know some people that do that, and it takes up a lot of time. But anyway, where Jerry's going with this is like, you know, all we're doing is responding to the trend.
Yeah. I put up a really interesting little 5-minute video from JC Peretz. He's All-Star Charts. He was the founder of this company called All-Star Charts. But it was like a video from like 3 or 4 years ago, and it talked about the sort of shortfalls of beginner investors. And he's talking about stocks. He's not talking about TSP, but he's talking about why you make emotional decisions and how you want to hold on to being right, even though price is telling you that you're wrong. You know, it's all the stuff that we always talk about, and you can absolutely apply it to how you kind of manage your TSP account. But it's a 5-minute video. It's definitely worth watching. So take a look at it. The newsletter is going to be good this weekend. It's important because, again, like you said, the caution flags are definitely out there, and the Fed is getting ready to cut rates, probably later in the year, maybe even the beginning of next year. But what happens, the punchline sort of is, what happens is, as investors are anticipating a rate cut, stocks move higher, and that's what's happening right now. But if you actually go, the sort of catch-22 of it is, if you go back and look historically at what happens when the Fed actually does cut rates, it's not what investors want based on what happens to price.
Right.
So, yeah, definitely take a look at that newsletter. Anyway, if you guys have questions, definitely hit us up.
Questions. If you have questions, send them to us. We love questions. Gives us a chance to answer them. Sometimes we use them on the show. Sometimes we just answer it directly. Wherever you find the comment section, wherever you find the video, there's a comment section. Put the questions in there. If there's no comment section, you can shoot us an email at support@growmytsp.com. We really appreciate you guys watching every week. If you like it, please share it with your friends. Yep. And hope all the mothers out there have a great Mother's
Day.
And we will see you guys
next week.